Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as stockcharts.com. So today I want to talk about why energy is such a hard trade here. And the real crux of the matter is if we're going into a recession, then everybody expects crude demand to slow. If we're not going into a recession, and this was the intermediate market low, then crude should continue to rally from here. So which is it? And what can we look at? And I will just say that the charts are hard here to try and make head nor tail of which way they're going. Crude continues to underperform, but some energy names continue to hold up. So it's really a pretty interesting trade. I'm going to start by going through some of the indexes and just explain what's going on here. We're up to the 200-day moving average. And we need to make sure that if the market's going to continue to rally, that's the area we want to focus on and make sure it can get through, and I'll show you why. Crude oil can't hold a rally. It hasn't been above its 20-day moving average for a long time here. And so now it's been below its 200-day moving average, and now it's back testing it, and it looks like it's not going to hold. So we really need to go figure that out. So is that bullish with lower gas prices, suggesting that we're going to have a good retail fourth quarter because people aren't spending as much money on energy? Or is it a sign that the economy is breaking down and we need to hunker down? All of those are big questions, and we really need to focus on that. So with that, I want to go and talk specifically about the S&P 500. And this is a picture of the S&P 500 from the year 2008. So October 31st, 2008 is the end of this chart. And the point was that in May, the market rallied up to a high and then rolled down. And then in August, near the end of August, we got back up near the 200-day moving average and fell apart. Well, maybe we're at the same time frame, maybe we're not. So the real question is, we traded well below the 200-day moving average, well below the neckline before. We traded down. And then as we rallied up, we got to the 200-day moving average, which was well above kind of the previous 3 months and gave us all a warm fuzzy that things were going to be good. Now in here we had bear stearns. We haven't had a bear stern, so that's a good thing. But then we pulled down, and then as we went into August, the market really struggled. It was really a sideways rally. And then we plummeted off the cliff. So a couple of things were important there. One was that the PPO momentum indicator at the May high, when it touched the 200-day moving average, got up to kind of the similar peaks as the prior high and then rolled over. So PPO for me is momentum. And what we want to watch for is, can it get positive and stay positive like it was on the left side of this chart? And then you can see as the market started to break down, it spent more time on the bottom side of the zero level than the top side. So that was kind of the picture way back. Now, if I roll out to today, and I've just got this set up here, I just got to find where it is. If I roll out to today, what you see on this chart is we have a lot of the same characteristics. So we wobbled around, we fell below the neckline, and we've rallied, and now we're rallying back up to this neckline. So again, if we wanted to just go back, let me just see if I can find that. There it is. We rally back up to the 200-day moving average just above the neckline, and can we hold there? So here we sit roughly in the same location above that neckline, right around the 200-day moving average. And the question is, can we break through that, or do we roll down? Now maybe we just roll down and then move higher again. But the bottom line is we keep having these declining volumes. So nobody seems very interested in pushing this market higher. And to me, that's a critical component. So today in the market, when we're looking, we need to make sure that the volume is also coming along. So I want to go back to the chart, and now I'm just going to go get a live version of that same thing without the trend lines on it, and one of the problems we're having here is see this low volume that we had Friday and Monday, and now Tuesday at least it perked up a little bit, but we're also starting to get a situation where we're right around the 200-day moving average. So what you end up having, like let's just pick that March high as an example. So we kept falling into that. That looks about right. And then well, here I'll use this tool. There's an inspect tool and that will give you a line. So we can sit here and line up with this. So here's a volume bump day where we had a big volume surge. So that was pushing up higher, and then all of a sudden, that was like a Wednesday, then we finished and we rolled back down. Now I think, if I'm not mistaken, that was I should go get it. That was close to a Fed day. I can do that. Let's go get it. And just make sure, because if that was the Fed day, then that's a reason for the volume bump. And I'm looking for options, expiration, and the Fed. So here was the Fed day at the end. It was March 15th, so it wasn't at the market top. So when we go back to this, what I want to make sure of is if it was the Fed that caused the rollover immediately. It wasn't. But now we sit at this juncture, and the real question is, can we break higher? I will say one bullish sign that happened here is that our momentum indicator got well above the previous highs here. So that's a nice change. And if we open the tape back up, what you'll see is, this is very bullish. This is more bullish than we've been over the last almost 2 years. So to me, it looks pretty strong and definitely worthy of thinking, are we going for some sort of a climax run? That's not really how it looks to me. It looks to me more like we're trying to start a new rally. So these are important turning points. Now, if we go back to that preview, so this again was sorry, not this one. Oh, Greg, I'm lost in my charts. What I want to show you is, where did that go? No. I must have wrote over it. My mistake. But the idea being, if we're going to have the market break down here, I want to make sure that I'm ready for that. And the only way that I know how to do that is to be acutely aware of historical examples of when the market started to roll down. So are we going to get some sort of an August failure like we got in 2000 and in 2008? Or is this going to just continue to move higher? And I got to tell you, the war on Twitter from the bulls is, this is a new bull market. And the war on Twitter from those who think we've just started the decline, they're yelling that it's, the end of the big boom, and they've seen this movie before, and of course we're going lower. All of that makes it very, very difficult. When I go to the Nasdaq, this looks like an uptrend to me, and it's been holding. The one thing I will say is the momentum indicator has basically shown that we're losing our upside momentum, but we're still holding at a high level. This isn't a problem yet. The PPO momentum indicator has not rolled over, but again, it's the volume. Let's just try to get an updated volume here. It's the low volume trend that I'm more worried about, that we don't seem to have any enthusiasm for getting higher. And if we just click on this chart, one of the features you can do, so this number here is 643.2 million. So you can just put a horizontal, whoops, not there, under volume, put a horizontal line at 643 million, and we'll just put it blue and put update. So that puts a line on it. What we're doing is we're just, by using that line, we're eyeballing, what kind of volume are we getting? And, some people will talk about, well, August volume is always low. I can tell you that some of the biggest volume rallies happened in August, and they had a huge surge in volume. So never short a dull market, which is low volume. But contrary, just because it's low volume in August doesn't mean it should be ignored either. So when I look at this, we got down here in July, that was kind of a flipping point. We got down here in June, that was a flipping point. And in April, even in the end of March, we kind of ran out of juice and there was no real volume coming in to support the rally. And then we really started to sell off. So when we continue to ask the question, as you can see, going all the way back to the beginning of the decline, this is one of the lowest volume days we had. So we had one in early January, we had some in April, but basically all of March through April was low. In June, we rolled over by not having enough strength. In July, we rolled down a little bit. And now here we are declining for 2 or 3 weeks. And the question is, does this rally have more to run, or does it need to pull back to, say, the 50-day moving average and give us another chance to have a look at it? So those are the types of things that I'm trying to weigh when I look at the market. Is the historical precedent is for us to be aware that the market could break down here, and if that was to start to happen, we at least need to be ready, because it could be meaningful. Again, if we're going into this big recession that everybody fears, then we've got bigger problems. And there's good data on both sides of the argument about whether or not the market can recover from this. After all, we already did decline meaningfully on the Nasdaq and on the S&P. So have we already priced that recession in, and now we're pricing the end of the recession and the world starting to return? Great question. So I'm going to leave it there, but I want to again point out just how important, let's go to a 10-year period, how important this break is below the 200-day moving average. And when you come back up against the 40-week moving average or the 200-day, what you want to see is that the market's able to really push above that. And I'm just going to now go back and add longer periods of time, and you can see in 2000 we got stranded below it, and that was a really good anchor point, and again in 2008. But other than that, it's typically support. I mean, there are dips below it, but the real question is, does it get back above? And so that's what we want to watch for. I'm hopeful that we can, and one of the real positives on this chart is that the Nasdaq has kept its uptrend compared to the S&P 500. So hopefully with all of that, I want to make the point that we're at a critical moment for the market to decide which way it wants to go, and try not to ignore that, because I think it's a pretty big deal. So this is the crude oil chart on the left. I'm going to move over now to the oil and what I started with for today's presentation. Crude oil, what we'd like to see, obviously, is that it hold above its 200-day moving average. Well, it actually closed at fresh new lows today, whereas natural gas closed at higher highs today and has almost taken out the prior highs. Now, natural gas is $9 in the US, and in Europe, it's wildly expensive. It's almost the equivalent of $400 a barrel for oil if you use the BTU equivalent. So this is a pretty meaningful gap that we've got here between North American natural gas, but to me this looks like a left shoulder head and a right shoulder, and when we break out of here, natural gas could easily make a move up into the $14 range, and I don't know if that's coming right away. But I would just say that that's the biggest thing I'm watching for. If natural gas starts to go ballistic, then you're probably going to watch oil turn higher. And one of the reasons for that is, even just as a replacement energy source, that people would move to the cheaper fuel. So some people can burn natural gas, some can burn diesel, some can use electricity, and they're going to flip back and forth as much as they can to try and lower their costs. As that happens, we need to be aware that the market should respond to that. So the crude chart is ugly, in my opinion. There's nothing telling us to get long here. If we wanted to see some sort of improvement on the chart, this should not happen we shouldn't end up with kind of this big topping structure and now we start to break lower. So you can see in November, December, we broke down there. If I go back another year, we broke down there in October. September, October, November, we were traveling below the 200-day, and then we immediately fired higher. So do we just have more months to go here before crude actually wakes up and recognize the tightness of supply? Good question, but so far it's underperforming the S&P 500, and that makes it a hard stock to own or a hard commodity to own. If we go to natural gas, now what you see is it's outperforming the S&P 500. It's got its big uptrend. It's come down to the 200-day multiple times, and that's been a great time to buy it. I think we're still in one of the biggest energy crises coming up. We've got issues around the sanctions on Russian oil, and we know that it's been that oil has moved to other parts of the world. But looking specifically at the chart, oil looks terrible, natural gas looks good. Now, that's an important thing to be aware of. Now let's go to what I call XOP, which is the Exploration and Production ETF. This has a mix of oil and gas stocks in it. So we can't just take one or the other. And if you looked at some of the large companies, they produce a lot of natural gas as well as a lot of oil. So it's not like an individual ticker name is one or the other. But the main thing here is we've got this big uptrend on XOP, and even today as oil hit another low, this chart is holding up. So is this chart just too dumb to get the message, or do they realize that crude's eventually going to turn higher? And this is a left shoulder ahead, a right shoulder, and we're about to break out to big blue skies. I'll tell you, it's a really hard trade to know. And when I look at the PPO momentum indicator, what you can see here is it has stayed above zero for most of this year, dipped big below, and now it's pushed back above, but it looks like it wants to roll over. So the question is, can it start to go higher? And if so, we're going to be in the next leg of the bull market for energy stocks. And if it can't, we've got a much bigger problem. There is another clue that we've got here, and that is that the uptrend in oil, in the XOP compared to the S&P 500 has been holding, but for the last 2 months, while the stock market has rallied overall, XOP has really just kept up with the indexes in terms of percentage moves higher, and so in June we fell really, really hard compared to the indexes. But now we've kind of pushed sideways. So all of these things are adding up to make for a big question mark. I'm just going to not take those. But the next way to look at this is to roll through the oil stocks. And we could go through each chart individually. We could do whatever. But I think if we just took the CandleGlance view, and the way this works is, if you want more, you can just minimize your screen and shrink it down and look at a lot more. To me, that's too small. So 3 could work or 4 could work. But I personally like just getting to 2 and taking a quick look. So this Adams Resources, this looks broken. We're going back to the beginning of the year here. So on all of these charts, it's roughly early January, but this looks like a head and shoulders topping structure. It needs to bounce pretty much right away here in order to convince me this wants to go higher. Antero Resources, again, you've got this topping structure where you got a left shoulder, a head, and a right shoulder. Are we breaking out to the upside, or are we about to roll over on the other side of the right shoulder and down we go? Good question. BP Prudhoe Bay, this thing is sloping down pretty hard, and again, can't really get above the 20-day moving average. Here's British Petroleum, up near the prior highs, but left shoulder, head, right shoulder structure, all in place. Big neckline around $27. If this doesn't continue higher, it's a pretty worrying place on the chart. And I think the overall indexes will have something to say about that. So if the overall indexes think we're going back into a big recession, we might just see that the oil stocks start to do that as well. Looking at Continental Resources, we still have a nice uptrend in play here. We want to see that hold, obviously, but if it starts to break down, that's just going to be another sign that this market isn't ready. CNQ is Canada's largest Canada's largest oil company. And the point I want to make here is the PPO momentum looks like it wants to roll over around zero. So it's not really a comfortable set of charts here if they can't continue to go higher. But each day it's been so volatile, and over the last 4 weeks, I can just go get that on a chart. Over the last 4 weeks, what we have seen, and I'm just going to change the chart style here to Elder Impulse System. And the reason I want to do that, it puts a green light or a green price bar for the chart. This is what I want to shrink. When it's very bullish, and it puts a blue one when it's cautious and a red one when the chart's breaking lower. So it does a pretty good job of telling you which side of the trade to be on. So we rallied and fell. We rallied and held. We fell. We rallied, and now we're right in the middle. So which way is this chart going? And again, it's very difficult to tell as we come to this decision point. So can we break through this 140 and 146 level and start to turn higher? Or the full stochastic, if it's to roll over here below 50, that's what it does in bear markets. Typically a weekly chart will roll down at that 50% level, and in 2019 it never even got up to the 50 level. It just kept rolling over. Then it had a brief cycle surge up, then we fell down in the COVID, and every time it made it all the way up to the top of the zone before coming back down. A rollover at 50% is not very good, and you can go look at a gold chart or whatever to see that. But I think the critical thing for me is, as I look through these charts, I'm looking for the trend, and are any of them really starting to break out to the upside? So far, no, but it wouldn't take much. Like if Cenovus moved up from, call it $18 to $21, I realize that's a 15% move, but as it goes higher, all of a sudden you're starting to make a higher low and a higher high, and your uptrend is underway. When we look at Chevron, it's trending above its 20-day moving average. That's what it did all the way through the first half of this year. So is it too early to call the end of this trade? I think it is, but it's definitely one worth watching. So try looking at different views, but this CandleGlance view, and you get to set up your own or use the Stockcharts default. I think it's a critical place to just be aware that if these charts can't keep performing, and the overall picture is that these stocks all start to fail due to a lack of demand for oil, that's a pretty big statement. It also would imply to me that the recession is real and the rest of the market is going lower as well. Now, for me, one of the biggest dates on the market is options expiration. And if you wanted to call it an options expiration cycle, what I'd like to know from that is the market going to be able to rally off that low? And what we saw here throughout the year is during this options expiration in March, we rallied out of there, and then here was kind of the breakdown below the 200-day moving average, and then we started to really fall away. This marked a cycle low at the end of May. Then we made a lower low by the end of June. So this is a negative one, this is a negative one, this is actually just a flat one. And then at the end of June to the end of July, we made a higher options cycle high. Here we're clearly going to make one higher, and that's on Friday. But the question is, what do we do as we approach this point? We have all kinds of things that are being put in play technically. The last thing I'd like to say is look on Bitcoin or Ethereum. Ethereum's been a little bit more positive, and I'm just going to go to a shorter time frame. What we want to watch for is, does this trend hold, or do we start to see these cryptos break down? Because they've actually done a good job of telling us if it's risk on or risk off. And again, it topped out right at its 200-day moving average after breaking above prior highs. This looks like a pretty steady run. Does it have the momentum to get through, or is this level, call it 2160, a real big hurdle, and it's just making a series of lower highs and lower lows, and it's about to go lower? Good question, but I think it's an important week to watch. So hang on to your hat. We need to make sure that the market has the structural strength to go higher. Thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recording on Stockcharts TV YouTube page. Thanks, everybody. Have a good week. Stay focused. Bye-bye.
Hey guys, Dave Keller here with Stockcharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.